Morning. Turning to a top story driving the action. Meanwhile, in early trading in business, a blockbuster quarter for Amazon. The e-commerce giant blew away analysts' expectations when it reported earnings last night, actually turning a hefty profit of $92 million a share. That was 19 cents a share in the second quarter. It was a surprise to see the company report earnings. North American sales and cloud computing helped push the company back into the black, and the stock is on fire pre-market. Take a look at Amazon. Stock up nearly 20% to open at a new lifetime high on Amazon.com. Today's rally will likely push Amazon's market value above its longtime rival Walmart's and other names you know, like General Electric and J.P. Morgan. Amazon shooting up to the top of the most valuable companies in America. I want to bring in Beacon Crest Capital founder and CIO Kevin Divney. Kevin, a surprise profit for Amazon. Is this the stock you own?
This is a stock we don't own, unfortunately, this morning, but it's a sector that we've been looking at for some time. Amazon reflects the innovation, and think about what they're challenging here. They're challenging Google on the cloud. They're challenging Walmart as being one of the biggest retailers. And also, it shows you that management can turn the dial and not as invest in much in infrastructure and therefore deliver this really blockbuster quarter after Wall Street missed it by just a wide margin.
And you know, for the longest time, people would be skeptical of Amazon, not really focusing on earnings and just generating revenue, but not having earnings as a priority. Today, they really surprised them, Joe.
They really did. And let's look more at those numbers for cloud services. Amazon Web Services up 81%. So really making a dent in that particular subsector. The North American sales, which were a concern, haven't grown that much over the past few quarters, up 25%. So if we are looking at the American consumer, we do see, at least for Amazon, a relatively healthy situation.
Yeah, and who would have thunk it, Maria? I mean, this is a stock that in 1999 and 2000 looked like it was probably going to go away. I mean, it was the world's biggest bookstore. But as has been mentioned, they've consistently innovated. They haven't stopped innovating. We don't even think of it really as a bookseller anymore. And that's why, at least from my opinion, profits have really never mattered too much, because as they've continued to innovate. So once we start to see some profits, the stock, as you said, has gone parabolic.
They absolutely have not mattered, because the stock kept going up, even though the company was not reporting earnings and kept generating revenue increases. Would you put new money to work in Amazon shares today after this big run up?
Today is probably not the right day, but you will see a pullback in the short term. But it also shows a company similar to Apple, where Apple is now one of the largest music sellers, that to be competitive in this economy, you need to continually innovate and challenge traditional business models. And that's what these companies keep on doing.
I have to say, I disagree. I mean, think about the dot-com stocks as well. As soon as the profits started coming in, the valuations actually started to contract. I mean, Cisco is a great example of that. The stock still trades lower than in the 2000s. So I think, ironically, bigger and better, more clear profits for Amazon will likely result in a lessening, in a smaller valuation and a smaller stock price.
All right, we'll see about that.
Yeah, and jobs, too. We can't forget that. Payroll at Amazon up 38%. So as a job creator, seems like Jeff Bezos might be really, hitting the mark here.
Yeah, and he's been acquiring. So there's been different jobs in various industries, because Amazon has been acquiring and publishing, et cetera. There's also healthcare to talk about. Anthem acquiring Cigna this morning. As we told you yesterday, $54.28 billion. This is an area that you've also liked for a long time.
We've liked healthcare services because there's a secular tailwind. For one, we have the demographic tailwind in the United States, obviously. We also have the ACA, where a lot of the private sector companies are going to be picking up the slack. But the concern on a longer-term investment thesis is that when you see this consolidation, what management is viewing is that perhaps lower margins over time. And they're trying to consolidate some of those costs at the high level. We don't see that happening right now. The multiples have been pretty stable, and the earnings have been coming in double digits in a lot of these companies.
This is a deal valued at $48 billion, but when you put in cash and stock, you're talking about $54.28 billion. This is a big deal.
It is, and it shows that they need to be a larger size to treat this addressable market that's emerging.
Do you think, though, that over time, with all of this M&A happening in the healthcare sector, that the prices will eventually rise? We have seen this, at least on a consumer-facing standpoint, for airlines, right? That as they consolidate, the consumer actually loses. Do you think that will still happen, especially with Obamacare, the ACA?
I think the consumer is going to lose, but it's not going to be driving so much from the private sector actions. It's what's happening from the policy actions. That's what's going to make the consumer. And we've already seen that in the last 3 years. The consumers are losing with their health care costs.
I have to say, I agree. I mean, where government gets involved, monopolies are created. And we've seen that not only in banking, which is government's gotten more involved since the healthcare crisis. The bigger have gotten bigger, and with insurance providers as well. So they create the monopolies, which ultimately hurts the consumers.
Yeah, well, we're seeing a lot of consolidation and bigger companies within healthcare, that's for sure. We'll continue following this. Stay